Whether you're talking about tulips back in the 1600s or tech stocks today, the pattern is just eerily the same. You get this euphoric, crazy rise, and then a catastrophic fall. It kind of seems like financial bubbles are a feature, not a bug of our whole economic system. So today, we're going to dissect that exact pattern, the anatomy of a crash. All right, let's just get right to it, because this is the billion-dollar, maybe trillion-dollar question on everyone's mind right now. We are seeing a massive explosion in AI valuations, and you just have to ask, have we seen this movie before? Is this just another bubble that's, waiting to pop? And when you dig in, the whole debate really boils down to this comparison right here. So on one side, you've got AI. It's being driven by these tech giants that are pulling in massive, very real profits. But then on the other side, you've got assets like crypto, where the value seems way more tied to, well, collective belief and the promise of what it could be one day. So are they the same thing, or are they fundamentally different animals? To figure that out, we first need a blueprint. And it turns out, financial bubbles, it doesn't matter what the asset is, they all tend to follow a pretty predictable script. So let's break down that anatomy. Okay, so the engine that powers every single one of these bubbles, it's psychological. The economist Robert Shiller, he came up with this perfect term for it, irrational exuberance. It's that exact moment when the story about an asset becomes more important than the actual numbers. It's when the fear of missing out, that classic FOMO, gets so powerful that it just completely smothers the fear of losing everything. And Schiller himself he nailed the human part of it with this quote. It's not just about simple greed. A big part of it is seeing your neighbor, your friend, getting rich and thinking, hey, why not me? That feeling, that psychological contagion, is what turns a regular rising market into a full-blown speculative mania. Now, what's so fascinating is this whole process isn't just random chaos. A couple of economists, Hyman Minsky and Charles Kindleberger, they actually mapped it out into 5 clear stages. So first, it starts with a displacement. This could be a brand new technology or maybe a flood of cheap credit that just changes the whole game. That spark then ignites the boom, where prices start that long, steady climb. This builds and builds into total euphoria, where everyone just throws caution to the wind. And right around then, the smart money, the insiders, they start quietly cashing out during the profit-taking phase, which happens right before the final stage, pure, all-out panic. So you might be thinking, is this 5-stage model just some abstract theory? Well, not at all. Let's actually put it to the test against some of the most famous crashes in financial history. I mean, who could forget the dot-com bubble? The displacement event was the internet itself, a world-changing technology. The boom went on for years, and then it climaxed in the total euphoria of late 99 and early 2000. The absolute peak hit in March 2000, and then came the panic. But just look at that recovery time. It wasn't a year or two. It took 15 years for the NASDAQ to just get back to where it was before the crash. 15! And if you really want to understand the sheer level of euphoria, you just have to look at this one number. At the absolute peak, the hottest tech companies were trading at 70 times their projected future earnings. 70! Think about that. Investors were paying for 70 years of profits that didn't even exist yet, based almost entirely on hype. It's just wild. And when that hype evaporated and the panic finally set in, well, this was the results. The NASDAQ lost more than 3/4 of its entire value. Companies that were household names, like Pets.com, they basically vanished overnight. The line between that 70x valuation and this catastrophic drop is about as straight as it gets. But hey, this pattern did not start with the internet. Not even close. Let's rewind the clock even further. Back in the roaring 20s, the displacement wasn't a new tech. It was this powerful mix of post-war optimism and a new financial toy for the average person, buying stocks with borrowed money or buying on margin. And the results of that bubble bursting? It was even more devastating. After the crash of 1929, the Dow Jones Industrial Average lost nearly 90% of its value. This wasn't just a market correction, folks. This was the event that triggered the Great Depression, an economic disaster that reshaped the entire world for a decade. And this is so important to remember. These crashes, they aren't just numbers on a screen. They have these profound, painful, and very long-lasting consequences for the real economy, for real people. Yeah, this is a really key insight from modern economics. You see, unlike a normal recession, where things kind of bounce back to the old trend line, a massive financial crash leaves behind permanent scars. It's like a deep injury that means the economy can never quite grow as fast as it could have before the crash. So if we look at the breakdown of the permanent damage from the 2008 crisis, it's pretty eye-opening. The biggest long-term costs were not just people being out of work for a while. The largest slice of this pie was the depletion of capital stock. That means factories that were never built, equipment that was never bought. And right behind that is TFP loss, which is just a fancy way of saying our whole economy got less efficient at creating things. Put together, those two represent a massive, permanent dent in our economic engine. Okay, so now that we have our 5-stage model and we've looked at the lessons from history, let's circle all the way back to our original question and see where today's most hyped up assets really fit into this whole picture. This table really lays it all out, comparing the AI boom today to the peak of the dot-com bubble. And wow, the differences are pretty stark. I mean, valuations are high today, for sure, but they are not 70x high. The money is coming from the huge profits of giant established companies, not just VC cash being thrown at unprofitable startups. And there's already proven established demand for AI services. This chart really drives that valuation gap home. I mean, look at that difference. Sure, 26 times forward earnings for today's AI leaders is aggressive. It's definitely optimistic. But it is not the same universe of pure, reality-be-damned euphoria that we saw back in 2000. The numbers just aren't in the same league. So, what's the final verdict using our framework? Well, it looks like AI is firmly in the boom phase. The excitement is real and it's grounded in actual profits, but that doesn't mean it's not at risk of a major valuation correction if growth slows down. Crypto, on the other hand, well, it frequently tips over into the euphoria phase, and because its value often isn't tied to any underlying cash flows, it fits the definition of a classic speculative asset, driven more by belief than by balance sheets. At the end of the day, if history teaches us anything, it's that these cycles of boom and bust are probably inevitable. There will always be new technologies, new financial innovations that create the perfect conditions for the next bubble. So the real question isn't if another one is coming, it's how prepared our financial system, and maybe more importantly, our own portfolios, are going to be for when it finally pops.